I'll start the first question, which is on our largest position, which is Edelweiss Financial Services in India. And the question is Edelweiss primarily value unlocking special situation for you via EAAA and other subsidiaries, or a long-term compounder you intend to hold for many years? Edelweiss currently has a market cap of about 1.15 billion, around there. They have planned an IPO of one of their 100% owned subsidiaries to take place in the April 2026 timeframe, about like four or 5 months from now. And EAAA is a fantastic business. It's an alternative fund management company, kind of like India's version of Blackstone or Brookfield and so on. And the expectation is that the market cap of EAAA, when it's trading on its own, may be somewhere between 1 and 2 billion. We don't know where it'll end up, but probably in that range. And so if you think about Edelweiss themselves with a market cap of about 1.1 billion, which has a number of other businesses besides EAAA inside it, we think it's kind of just ridiculously undervalued business, because we saw the same thing happen when they IPO'd Nuvama, which now has a multi-billion market cap. And again, Edelweiss was under $1 billion market cap, and that was rolled out. And Edelweiss will probably be doing these IPOs for the next 5 or 6 years, with the next 5 to 7 subsidiaries. Each of them could be 500 to $1.5 billion type market caps as they come out, with varying degrees of ownership by Edelweiss. So we like a lot of these businesses that they are spinning out. And our intent at this time would be to hang on to these businesses. We like these businesses. And so as long as the businesses stay great businesses and the valuations don't get completely egregious, we'd like to hang on to all of them. Going on to the next question, which is on Turkey. How do you price currency and governance risk in Turkey for long-term holdings like TAV and Resas? Let me just take the governance issue first. So when we look at a business like TAV Airports, they are 44% owned by ADP, Airport de Paris, which is traded in France, and it's significantly owned by the French government. And I think ADP has board representation, and I think is exceptional steward of our capital on the board. Even the non-ADP board members are exceptional. With TAV Airports, we really have no concerns of any kind on the governance or management front. We think the leadership is exceptional. We think the board is exceptional. We think it's very shareholder oriented. So we don't see any issues there. Resas is family-owned business where the principals have a large stake. Collectively, between the Wagons Fund and our private funds, we have a large stake. And we've been shareholders and, kind of learning about Resas for about more than 6 years now. And we have not seen any issues which give us concern on the governance side. I think it is run for the benefit of shareholders, for maximization of shareholder value. We have seen tremendous appreciation of our position over the years. And we think that the value creation at Resas is truly exceptional as far out as I can see. So in both cases, we have no governance issues. When you talk about the currency issues, in terms of TAV Airports, a lot of their revenue is coming from outside Turkey, but even the revenue inside Turkey is contractually obligated for the most part to be paid in euros. So the passenger fees, security fees, etc., are all coming to them in euros. And in fact, they are generally a beneficiary of currency devaluations. They've historically gotten a tailwind from it. In the case of Resas, some of their leases are priced in euros, but even the ones that are priced in lira get annual adjustments for inflation. They don't fully adjust for the real inflation rate, but they have catch-up provisions in the law after 5 years and 10 years. So when we look at the entire Resas portfolio, in general, the rents they are collecting are significantly below market, but there are adjustments that take place every year which get them closer to market. And Turkey's inflation rate is coming down very fast. So we may be in a position in 2 or 3 years where the inflation rate is single digit, maybe even mid-single digit, 5-7%. And in that environment, I think RESAs will not have such a big delta between market prices for their rents and the actual rent they're collecting. So in both cases, we don't see an issue with the currency or the governance. Moving on to metallurgical coal, you've highlighted Warrior and Alpha as amongst the lowest cost met coal producers. How confident are you that long-term supply is inelastic, given reports of significant expansion projects and greenfield capacity in the pipeline? So the metallurgical coal business and the various grades of metallurgical coal can lead to a confusing picture globally. What we are talking about is the highest quality seaborne met coal, which is priced off the Premier Lowball Index, FOB, Australia, Queensland. And that premium quality PLV coal is scarce in the crust of the earth, and it's only found in a few places. There are always possibilities of finds, new finds or new reserves, etc. But the development, mining, and transport of coal is very complicated. So even if there is a discovery of coal, the first question that comes up is how far is it from the port and what is the logistics to get it to the port. So, for example, one of our holdings is Mongolian Mining Corporation, and I visited Mongolia last year, and those reserves are phenomenal reserves. They are actually surface mined reserves, which is rare, very rare for met coal, but it's very far from a port. And the Chinese have reconfigured their supply chains to put a lot of their steel mills relatively close to the Mongolian border so they can take advantage of that met coal. But the transport, even with those mills being close by, is very complicated and very expensive. So we don't think you can find a mine or find reserves and then bring it to market in anything less than 5 or 10 years. And so we don't see a lot of change or increase in the global high-end production of met coal for quite some time. There are actually mines that are going away or mines that are long in the tooth. So we think the supply versus demand situation is very favorable on met coal. No guarantees, but I think from a risk-adjusted basis, it's a good probabilistic bet. And then how do you compare owning operators like HCC and AMR, where you take on operational risk, to royalty-style businesses like NRP that simply distribute free cash flow? Why choose the former over the latter? So when we look at the met coal space, and we looked at NRP in some detail, and in the end, we decided to take a pass for a few reasons. The first reason is it's a MLP structure, which requires it to distribute cash flows in the form of dividends. And in a mutual fund structure, we are not able to pass it through like we could in a private fund. So at the fund level, it would get taxed. MLPs have a little bit of inefficiency from our point of view on that, fund level taxation. When we look at AMR and Warrior, one of the big differences between the two companies is that AMR does not issue a dividend and is very focused singularly on buybacks. They are completely bought in on buybacks. Warrior has, because of their legacy of the bankruptcies, they have a lot of NOLs, and those NOLs may get affected if Warrior were to go very heavy on buybacks. So they've been burning through those NOLs, and it's also because of the NOLs that they are not able to allow anyone to own more than 5% of the stock. And we think in the next year or two, or maybe 3, Warrior will remove those restrictions because they would have burned through at least a lot of the federal NOLs. I think they still have a lot of state level NOLs. So Warrior has much better mines than Alpha, but Warrior has less efficiency on the capital allocation in Warrior because of this legacy. But if we look out 2, 3, 4 years, buybacks may become a big part of the Warrior story. They'll never be a big part of the NRP story because they have to distribute. And also the torque that we get from owning the miners directly is higher in a high-priced environment. So if we get to 250, 300, 350 PLV, the cash flows go totally bananas on the Warriors and Alphas of the world. They go up on the MLPs, but not quite at the same level. So these are some of the reasons why we prefer owning the miners, even though there is a operational issue that comes up. But it's a good question. Given Transocean, which is offshore oil services provider, given Transocean's higher leverage and bankruptcy-free history versus peers that cleaned up their balance sheets through restructuring, what makes it your preferred way to play the offshore cycle? So one of the very important, the leverage that the offshore drillers have is a very important piece of the equation. That's one piece of the equation, though. The second piece of the equation, which can maybe even dominate more than the first piece, is white space, which is when they have ships that or jackups, etc., that are not deployed. So a drill ship that comes off a contract and is waiting for the next contract is typically going to be fully crewed and almost have similar expense to what it had while it was under contract. So a drill ship might have a daily cost of $150,000 to $175,000 a day while it's on a contract. While it's sitting idle, it will still have a cost of more than 100,000, maybe 100 to 150,000 a day while it's sitting idle waiting for a contract. And so one of the adjustments I made when I looked at these companies is I looked at white space and leverage, kind of like two sides of the same coin. Because if I have a ship sitting idle that's costing 100,000 a day, I'm going to be bleeding about $35-40 million a year. If it's costing me 150,000, it might be 50-60 million a year for one ship. And that's significant, which means that, a working ship is almost offsetting what you're losing on a idle ship. Transocean looks very different from Noble and from Valaris from a white space point of view. In 2025, they have almost no white space, which is amazing compared to the other competitors. And in 2026, almost till the middle of the year, they have no white space. And if I look at their 2026 cash flows after, all the interest payments and everything else, if they did not sign a single additional contract, they would be generating somewhere around 500 million of free cash flow. The other two players, Valaris and Noble, have significant white space in 2025 and a significant amount of white space in 2026. So even though they have less debt, the white space comes in and crimps your cash flows. So when we stress tested all of these businesses against different scenarios, what we found, especially with Transocean, with the recent equity offering they did and debt offering they did, where they kind of raised about $1 billion, is we don't see any issue coming up for them in terms of their balance sheet and such, even in a very extreme nuclear winter scenario of almost no new contracts. And the other two players have a little bit more dependency on the new contracts. In the case of Noble, so first of all, we like all of them. I think they all have kind of a great business model. But Valaris and Noble kind of have some offset on the lack of debt with the white space. And another thing I would just like to point out about the white space, the reason there is white space, in my opinion, is because of one of three things, and probably a combination of all three things. Quality of the ships, quality and features of the ship is the first issue, quality of the crew and operations, and business acumen in doing contracts. So I don't still understand the industry well enough to tell you that, what are the ratios of these three. But what I can tell you is that Transocean stands out versus the other two in terms of the lack of white space, which basically informs me that a combination of these three factors, it is superior to the other two players. And one of the advantages of not going through bankruptcy is the other two players were cut to the bone when they went through bankruptcy. They lost some of their best people. They lost some of their best talent. And Transocean went through some of that when Carl Icahn came in and, pushed them to cut costs, etc., but nothing like what the other two went through in bankruptcy. So there's a little bit of a difference in how these companies look like because of their history on that front. And moving on, can you share any updates on Resas, particularly around the capital raise and any operational or balance sheet development since the last call? Yeah, so every year I visit Istanbul and I sit down with Resa's management and I go through, kind of what's been the situation of the business and so on. I'm always impressed. So they are a very opportunistic player. They don't really have a strategic plan. They basically come into work every day and they look at what's the best they can do that day. And if there's nothing to do, they do nothing. So to give you kind of a recent deal they had done is that there was in Istanbul, availability of land for warehouses, a zone for warehouses is very scarce. It's very tight. That's why the warehouses are like 99% leased and inflation index, even though the Turkish economy is not currently doing very well. So the government auctioned off a very large piece of land, which was zoned for warehouses. And Resas was the winner of that auction for 2 billion lira, which is approximately $47 million or so. They just closed on that transaction earlier this week. And they already have like 4 different companies that want warehouses on that space. So they're going to begin construction, but it will not be spec construction. Probably going to have a lease in place with one or more players. They also might sell off some of the land because there are some smaller pieces there which don't fit for them. But basically, this is going to be 200 plus million of debt plus equity that goes in, 250 million of debt and equity that goes into building these warehouses out. And I don't think they'll hit it out of the park in terms of the returns, but they'll still produce very attractive returns on this bet and increase their footprint and become more dominant on the whole space. They've also recently entered Germany. They've formed a 100% owned German subsidiary called Resas Deutsch. And anytime Resas starts a new business or enters a new venture in a new area, they tend to start small and they want to kind of put their toe in the water and see how they go. So this is a very small bet where they're basically building 39 apartments and they have a joint venture partner, kind of 50-50 relationship. I think the economics are that they're putting in less than 4 million euros into this project. And when it's completed in the next year or 18 months, they'll have more than double their investment. And their plans are not to monetize and sell, but to become a landlord and basically rent these units out so that new co in Germany starts getting cash flows and they start looking at other deals, etc. So they've kind of planted a seed in Germany. It's their first real estate deal outside Turkey. And Germany is a very logical place for them to go because there's a lot of strong ties between Turkey and Germany. Basically, after World War II, as Germany was growing very rapidly and they had lost so many young people in the war, they basically had a big shortage of young people and they en masse brought in migrants from Turkey to help build the economy. And so there's a very significant Turkish population in Germany that's been there for 70 plus years, etc. So that's pretty good. With GMAT being a new position in your hedge funds, is it also something you plan on purchasing or have purchased for the mutual fund? Also, what's the thesis behind the company? So GMAT I would say it's a very embryonic business. It's a relatively small company in Turkey. Easiest way to think about it is it kind of looks like Turkish Costco. They have 2 stores currently. They used to have only 1 store a year ago. And the Wagons Fund owns a stake in GMAT. And I visited both the stores a few months back and I visited with the leadership. GMAT is a very interesting business in the sense that it was started by 1,000 wholesalers coming together, each one basically owning 0.1% of a new co that they started a few years back. They had in mind that because they had so much expertise on almost the entire supply chain of supplying to retailers and grocers in Turkey, that they could basically create a store which was kind of a pseudo wholesale store in a very large footprint kind of situation like a Costco. There isn't much of that in Turkey. In fact, I think they're very unique in what they did. And the price points at which they're operating and the margins at which they're operating have made these first 2 stores incredible successes. In fact, normally when a retailer is opening a new store, it might take 2 or 3 years for the sales to ramp up because it's new and people have yet to hear about it and so on. But when they opened their second store, the sales instantly did a step function. They took off in a major way, simply because the kind of value you get and the selections you get and the environment in which you shop is very attractive and very favorable. So I think that it's almost like a venture investment, even though I don't think it's like a venture investment from the point of view that the risk profile is very low. So we feel that if the company has aspirations to have 80 or more stores in Turkey, they also have aspirations to maybe have stores at some point in Germany. I told you there's a huge population of Turks in Germany. And I don't know whether they will be able to pull it off or not. When I look at the DNA of the company and I look at the management of the company and I look at the culture of the business, I see a lot of resemblance to Costco. And I see a company that is more likely than not to make it. But early stage businesses like this with 2 stores, I mean, I would be able to give you a better read if it was 10 stores or 20 stores and I had more trademarks to look at. So we made the bet relatively early because we like the situation. It's also a reluctant public company. They did not want to go public. The Istanbul Stock Exchange tapped them on the shoulder a few years back and said, hello, you have more than 600 shareholders. And if you have more than 600 shareholders, you are deemed a public company and you have to list the company on the stock exchange. So they were forced to list the company on the stock exchange. Pabrai funds, my private funds and Wagons Fund and some other entities that I control collectively own now more than 20% of GMAT. We are the largest shareholder in GMAT. I mean, I think of it as a possible compounder. I mean, if they do actually execute on their plans, it would be an incredible home run. But, there are a lot of things they have to do to make that happen. It's not easy. So we'll see how that goes. But we like everything that we've seen so far. For offshore drillers generally, how do you estimate replacement cost and think about how today's day rates and utilizations would have to evolve for the stocks to approach that value? Well, the estimation of replacement cost is fairly straightforward. I mean, if you talk to the various insiders at these businesses or analysts, etc., a drill ship, like a 8th gen drill ship that one might want to order is unlikely to be available for less than $1 billion. It's also unlikely to be produced in less than 5 years. In fact, a lot of the expertise for building drill ships is gone. People have left the industry because the industry has been in a nuclear winter. There hasn't been a drill ship built in like almost a decade. And so there's a lot of things that would need to have to come together. Also, the shipyards, they're booked solid and they aren't going to be willing to take an order for a drill ship without a very large deposit, something like a 50% deposit. So there are industry insiders who believe that the last drill ship to be built for humans has already been built. And there are others who believe that there are possibilities that a national oil company or someone like that could build a drill ship. Basically, in order for one of these offshore drillers to justify placing an order for a drill ship, you would have to be approaching 100% industry utilization of the existing ships. You would have them having a contract for 10 or 20 years, approaching $1 million a day for these ships before they would be willing to put up the capital to do something like this. So from our point of view, the way I look at it is that the fleet that exists is the fleet that exists. If there's a drill ship being built, all the rates for everyone is going to go up before that ship gets delivered. So it's not really, the replacement cost is not relevant to us when we're doing valuations. It's a relevant data point to tell us about the kind of size of the fleet and how much more capacity might come on and that sort of things. Bottom line here with these businesses is that the current daily rates do not justify the building of any of these ships. All the rates would have to more than double, 2 to 2.5 times the present rates for any justification of these ships. And there are some cold stack ships that would need to come back first. So our take on the industry is that the capacity utilization is, depending on how you look at it, approaching 90%. As you start pushing 90, 95% utilization, upward pressure on rates becomes real. And then there's a lot of torque where even if rates go up 10, 20, 30%, the cash flows of these businesses might be going up more than 100, 200% because they would have no white space and they would be, every ship coming off is, being put out at 50% more than the previous rate and so on. So again, none of these are kind of guaranteed, but we like the risk reward of these situations here. And so that's why we have a bet here. How do you weigh the risk that easier financing for met coal versus thermal coal could cap prices over the long term, similar to how shale capped oil? Well, so in order for capacity increases to happen in metallurgical coal, there's a number of stumbling blocks. First stumbling block is that there is no equity capital available and there is no debt capital available for anything that has coal in the name. So people, the banks and equity players and so on, those don't distinguish between thermal coal or met coal or any other coal. They want nothing to do with coal. So first of all, it's very difficult to raise the capital, debt or equity. The second is that not in my backyard. So to get a permit to get a mine going, so even if you find reserves or find a thick seam somewhere, going through the process of actually getting permitted and, deals to be able to extract that coal is a difficult situation. The third thing is that the transport. So if this thing is not near a port and depending on the country and the different logistics, that's another stumbling block. Even when you remove all the stumbling blocks, you're looking at 5 to 10 years from the time a reserve is identified to the point that something is shipping into the market. And so there's a very long gestation period here. And so we just don't see a huge increase in supply coming on suddenly for quite some time, if ever. Moving on to, we have some bets on home builders. With high home prices, reduced affordability, and elevated mortgage rates leading to cautious 2026 revenue guidance from builders, what is your long-term thesis for this group? So the home builders we have bets in the portfolio. We have 2 bets with Toll Brothers and Pulte. They are amongst the lowest conviction bets we have, even though we like them. Basically, home builders have a few things going for them on a kind of, you take a step back. First of all, the housing stock in the US is basically short by several million homes. Depending on who you ask, 5 to 7 to 10 million homes. And homes that exist, the stock is getting old and dated. So we need to be building about 1.5 million or more homes every year, which is not happening, which means that gap is extending. Now, in order for those homes to get built and bought, we need a robust economy. We need low interest rates. We need people doing well. We need young people kind of moving out of their parents' homes and all of that. And there we have challenges where, the economy and affordability and the mortgage rates and all that. So there are headwinds which are in place currently. But one of the tailwinds that is going on with the national home builders is the national home builders have a secular advantage versus the mom and pops. It has become a very manufacturing oriented industry. They are able to have a significant cost advantage versus the smaller players. So they have a margin advantage versus the smaller players. And there's a few national players. So basically, the consolidation of the industry is giving more power and more margin to the best and largest players, which is a secular trend that's continuing. So that trend, and at some point, we may see interest rates lower and the pressure of not having enough homes and all of that, we think it works well. And I think the second change that has happened in the industry is the large players have become capital light. So it took them about 2 decades to learn from the NVR model, but they're all moving towards that model. They're not holding large banks, land banks. They're holding options on land and just-in-time purchasing and all of that. So they are very cash generative. Multiples are relatively low, so they can engage in buybacks and so on. And so we like the governance and we like the way these businesses are run and we like the long-term tailwinds they have. So that is why we have them in the portfolio. For Occidental, how do you view the OxyChem Berkshire deal and what it implies for Occidental's long-term economics and capital allocation. Our Oxy bet is again one of our lowest conviction bets, probably even lower than the home builders, but I still like the bet. And the OxyChem deal that Berkshire did is a very good one for Oxy, and I took it because it takes their leverage down. They had pressure on their balance sheet, and this has given them heavy breathing room, which is excellent. I think the Oxy thesis eventually is likely to be one or two factors that drive it. So one is if we get pump in oil prices at some point, Oxy is a big beneficiary of that. And the second is that if there is further innovation on fracking, which brings down the cost. And Oxy is already one of the lowest cost operators, but if they're able to kind of pull one more rabbit out of the hat, and fracking has already pulled many rabbits out of the hat. Charlie used to say that it's not a zero probability that they could put one or two more rabbits out of the hat. And so there are some upside scenarios with Oxy on that front with a very relatively muted downside. And so that's why we have that bet. Moving to general question is, how do you reconcile your circle the wagons philosophy of a few high conviction bets which with mutual fund constraints on maximum position sizes and ownership limits? So very good question. In our private funds, for example, we don't have these constraints of diversification, et cetera, being dictated to us. What I might do in an industry like coal, I might have all of it in one or two bets, highest conviction ideas. When we move to the mutual fund, it might be top four. And so if I were looking at the home builders, and I had full discretion, I would just pick one. But because I need to diversify, we end up with two or three, and the same with the car dealerships, etc. We end up with multiple. But we don't think that's a big penalty we're playing. There's not that much of a delta. We're okay with that. Could you walk through an example of a business you seriously considered but ultimately rejected? And what specifically made you say no? Yeah, so a couple of examples. Maybe I'll go through one example just in the interest of time. Is when we were looking at the car dealerships, we did a lot of calls and we did a lot of site visits to the major players and different locations. And we thought the highest quality business in the car dealership business was Penske Automotive. And with Penske, they have an amazing truck business, which is headquartered in Dallas. We visited and spent a whole day with them, which is fantastic, incredible. They also have truck leasing services business, which is based in Pennsylvania. We also visited that business, spent a day in Pennsylvania, and that's another incredible business. And then when we visited different Penske dealerships, for example, in Austin, there are two Lexus dealerships. Lexus particularly has very tight restriction that no single owner can own more than 8 Lexus dealerships in the country. Penske owns both of them in Austin. And when we visited those Lexus dealerships that Penske owned, which is a total monopoly, you would have to drive 150 miles or something to find another Lexus dealer from Austin. They were run in a world-class manner, very good people. All the people we met at Penske blew us away. They were the highest quality people. And then we also visited BMW of Austin, which is also owned by Penske. So Penske, I met Roger Penske briefly at the memorial service for Sergio Marchionne in Detroit a few years back. He was sitting right behind me. And now, of course, we've seen Roger in the NASCAR series. So Roger is the real deal. He's a exceptional businessman. He's a high quality operator, and he does not want to have anything to do with businesses that don't have the highest quality. So we like Penske a lot. I think it was great. Now, the issue was that Penske was trading at 50 to 70% premium in price to the other car dealers. And the other car dealers were not slouches. So we visited Ashbury, Group 1, Lithia, AutoNation, and so on. We definitely think Penske was higher quality. But when you're doing buybacks at 18 times cash flow versus 8 times cash flow, that makes a big difference. And so that was an example of a business where we spent a lot of time, but in the end, we decided that risk-reward basis, some of the other players were better investments. How long are you willing to hold Edelweiss and its demerged IPO businesses? And what would make you shorten or lengthen that time horizon? Yeah, so I think we might have answered this question earlier, but basically a lot of the businesses that they have long-term tailwinds, good businesses, capital light, high returns on equity and high growth. So if the businesses are doing well, they've got good management, etc., we would like to keep those businesses. India has a lot of tailwinds in financial services for quite a while. We have about 11 minutes left, and I've gone through about 14 questions, so we'll keep going and see how deep we can get on the list. Warrior has a very strong outlook and a new long wall coming online, yet it's only the number 3 position, roughly half Edelweiss's weight. Why isn't Warrior larger if you still see potential for a 10x outcome? So the Warrior position is not half of Edelweiss. I think it's, if I look at it currently, in fact, today was the first day Wagons Fund went over 100 million in assets. So we were very excited about that. But if you look at, and all the met coal names went up a lot today. But if you look at Warrior, it might be like maybe 30%, 30 or 35% less than Edelweiss. It's not that much. I think it's a 13 to 15% position, and Edelweiss is like 18, 19%. And so we're both big bets. And I've already pointed out that Edelweiss itself is very undervalued. And I think we would have a healthy debate internally if we would try to figure out which one is going to do better. And they both have a lot of torque. For Alpha Metallurgical Resources, how do you get comfortable with the path to 700 million in sustainable profits given current volumes and pricing? What needs to change to get there? So the Warrior bet is a very simple bet. If you have a business that you can buy for 2 billion, that business will be around for 50 years and then disappear. And in the next 50 years, the cash flows it will generate may range from 0 to 100 million a year, all the way up to maybe 2 or 3 billion a year. So if that is the range of cash flows, maybe 100, 200 million on the low end, and 500 billion, billion and a half, or 2 billion or more at the high end, and you got 50 years of this and you discount it, where do I sign? And so when you talk about a 700 million profit for Alpha, the very simple math is they produce 15 million tons. If I wanted 150 million in profit, they need to make $10 a ton after tax. And if they make like 40 or $50 a ton, they would be making the 700 million. So you look at the 40, 50 million per ton, and then you look at their cost structure. The cost structure has some variance with the price. So their current cost structure is about $135 a ton. If the PLV is at over 200 now and they're getting a $30, $40 margin, that's a good business. But if you get to 250 a ton, 300 a ton, the cash flow goes bananas. So I think it's not very hard for a business like Alpha to produce 5 or 600 million in cash flow. 5 or 600 million in cash flow is only about $30, $40 a ton. And their chief operating officer, Jason, who I think is a total rock star, he's probably one of the best 2 met coal miners in the United States. And Jason can squeeze blood out of a rock. And he has dropped AMR's cost very significantly in 2025. Really surprised us that he was actually able to drop the cost as much as he did. So they've moved further back on the cost curve. They're still more expensive, much more expensive than Warrior, but they're in a very good position to make very good profits at a PLV of 200 to 250. And PLV 200 to 250 does not require heroic assumptions. Moving on to roughly how much of the current portfolio is cloned from other investors versus original ideas which investors have most influenced specific current position, and which investors have influenced most. Well, they've come from all over the place, but I would say that, as you know, that I am the shameless cloner. And I would say all our Turkey positions are cloned. One of the things about the interesting thing about cloning is that our original interest in coal came from Consol Energy being bought by David Einhorn and it being his second largest position. And that sent me down the rabbit hole of coal. And when we went down the rabbit hole of coal and we studied everything in coal, we ended up basically moving away from Consol and ending up with, Alpha and Warrior, etc. So Alpha, Warrior, Mongolian mining, etc., are not cloned positions, but they came from original interest in a coal position that we cloned. And similarly, I think that the drillers, we were interested in Valaris coming from Kapi, but then, we broadened the horizon. Now we have bets that are not Kapi bets. So I think that the home builders have also come from looking at other investors I admire. The auto dealerships, I think I can't point to who I was looking at, but I've seen it in portfolios. Oh yeah, actually, I remember who we got the auto dealers from, but that was another cloned position. I don't think there's a whole lot. We've owned Edelweiss for a long time, and I think the first time we invested in Edelweiss, the first time I met them, might have been more than 10 years ago. And that may not be a cold clone